Hi everybody, this is Lara with your end of the week video for gold for the trading week ending Friday 7th of February. I'm expecting that the upward movement was a little counter trend bounce this week and it's over. I'm expecting a third wave down to begin next week. It could be a third wave at 2 degrees. Along the way down, a new low below 1536.52 would invalidate the alternate bearish count. That would add confidence that we have a sustainable high in place. My main wave count for gold is bearish. I do have an alternate bullish wave count for gold. It does not have as much support from classic technical analysis. This is the main wave count, and it expects that the bear market for gold has just resumed, that this movement was a counter trend movement within a larger bear market for gold. And when we look at this movement at the monthly chart level, when it's over, it should have an obvious three-wave look. The bear market is a correction. The bear market has a five-wave structure for supercycle A over here. This is the major low in December 2015, and this upward movement is seen as a B wave. It subdivides very well as a double zigzag. The first zigzag in the double is complete here. It's labelled cycle wave W, and from this low to this high, this movement does look very much like a typical three-wave structure for gold. It's very difficult to try and force a wave count which sees it as a 5, and that's a big reason also why this is my main wave count. The double zigzag is joined by a corrective structure in the opposite direction, labelled cycle wave X. X waves are almost always zigzags, but they can be any corrective structure, and in this instance it subdivides well as a regular contracting triangle. The second zigzag in the double may now be complete. It's labelled cycle wave Y, and from this low to this high it looks like a really obvious three-wave structure at this time frame, as does cycle wave W. They both have very typical three-wave looks to them. If this wave count is correct, then a new huge bearish move for gold will be labelled supercycle C, and it will be expected to move at least slightly below the end of supercycle A to avoid a truncation. When this confidence point has been breached and the bullish wave count is invalidated, at that stage I will then calculate targets for supercycle wave C for you. I'm not prepared to do that while the bullish wave count remains valid. Okay, let's take a look at the daily chart. We're going to look from this high here of primary A within cycle wave Y. This point here, here's a zigzag for primary B and an impulse for primary C, which has a very typical curved look. This is what gold's impulses almost always look like, particularly impulses at higher degrees like primary degree. Gold's impulses have a curved look because the second waves early on in the movement are usually deep and time consuming. Momentum builds through the third wave and it explodes at the end of a third wave. The fifth wave of a third wave at one higher degree is very often particularly swift and strong, and that forces the fourth wave correction, which comes just after, to be relatively brief and shallow compared to its counterpart second wave. This second wave lasted a lot longer than this fourth wave. That's okay. This is absolutely typical for gold and pretty much most commodities. Gold especially exhibits this behaviour very frequently. It ends its movements often with blow-off tops for bullish moves. The new trend often starts reasonably slowly. The first, second wave corrections within it are usually deep and time-consuming. Momentum would be expected to build through the middle of the third wave, and when we get toward the end of the third wave at primary degree further on, I would expect selling climaxes and very strong downward movements, and then again at the end of cycle wave 3 to come. I'm expecting supercycle wave C may take 1 to several years. It could be even over 10 years in duration. But bearish moves for gold do tend to be more brief than bullish moves, and so the guideline of how long to expect this particular wave degree to last should be approached with more than usual great flexibility. Within minor wave 3, no second wave correction may move beyond the start of its first wave. The invalidation point here remains the same. Along the way down, if we see a new low below this price point, we can have some further confidence in this wave count. A new low below this price point adds further confidence, and full and final confidence below this point. You'll see why that point is so important when we get to the bullish wave count next. At the hourly chart, here's the end of minor 2, here's minute 1, and now minute 2 subdivides very well as a zigzag ABC. I've redrawn the Elliott channel around this to be an Elliott channel. Draw it from the start of A to the end of B. Place a parallel copy on the end of A. There's an overshoot for the middle of a third wave. This is the strongest portion of the movement. This looks absolutely typical. Depending upon your risk appetite, you may want to use this channel for confidence. When we see a downward candlestick, a full hourly candlestick of downward movement below and not touching this trend line, then we can have some reasonable confidence that this correction labelled minute wave 2 is very likely over, and then a third wave down at 2 degrees is very likely to have begun. Alternatively, at the daily chart level, this wave count now just doesn't have the right look. I'm considering all possibilities though. What if the sustainable high is not in place? What if primary wave C has its final fifth wave to come? The problem now is the duration of sideways movement here. It just doesn't look like part of this piece of movement here. If primary C has a final fifth wave, the target is for primary C to reach 0.618, the length of primary A, and within intermediate 5, no second wave correction may move beyond its start below this short-term invalidation point. And so that's why a breach of this invalidation point would add confidence to the main wave count. And so even though this wave count no longer has the right look and has quite a low probability, it can still be useful in providing confidence points for the main wave count. At the weekly chart level, let's consider the possibility that the bear market for gold was over back down here, even though at the monthly chart level it looks like an impulse and not a correction. What if it was a zigzag or multiple zigzag? It can subdivide as a double zigzag. If that's the case, then a grand supercycle fourth wave may have ended here, and a grand supercycle degree fifth wave may have begun. So far, cycle waves 1 and 2 may be complete. 3 may also be complete. Cycle 4 may now unfold over several weeks or even months, and it may not move into cycle wave 1 price territory below this invalidation point. This is a very important price point for the Elliott Wave analysis. A new low by any amount at any time frame in coming weeks or months below this point would add a lot of confidence to the bearish wave count. It would invalidate this bullish wave count, and then I will add targets for the bearish wave count. I'm not prepared to do that while this wave count also remains viable. Cycle wave 1 here is very problematic. It does not look like a normal impulse for gold. I showed you on my first daily chart that typical curved look of gold's impulses, and that happens because the second wave corrections are usually deep and time consuming. The fourth wave corrections are usually brief and shallow. Here the disproportion is the other way round. This is an extremely unusual look for gold's impulse, reducing the probability of this wave count quite substantially. At the daily chart level, here's the end of cycle wave 3. Cycle wave 4 may have begun. It would most likely subdivide as a zigzag because cycle wave 2 was a combination, although cycle 4 can be any corrective structure. A zigzag is, by quite a wide margin though, the most likely structure, where A needs to subdivide as a 5, B a 3, and then C a 5. Within A, intermediate 1 and 2 could be over. Within intermediate 3, minor 1 and 2 could be over. For the short to mid-term, the direction is expected to be the same for both the main wave count and this rather unlikely bullish wave count. The shorter term invalidation points are also the same. At the hourly chart level, the wave counts look exactly the same, the channel is the same, the bounce is the same, the expected direction next week is the same. This week for gold, prices overall, it's completed an outside week with overall downward movement. The candlestick is closed red, but volume has not actively pushed price lower. Price has fallen of its own weight, and there's a bullish implication in this long lower upper wick. Support remains about 1565. It has not yet been breached. On balance, volume is making new highs, while price has not. Here, there's a little bit of bullish divergence. On balance, volume would tend to support that alternate bearish daily wave count. But ADX reached very extreme for this upward trend, and then RSI reached overbought as well, and then it exhibited bullish divergence with price from this high here to this high. between these two highs. That setup is often, not always, often seen about a point of major trend changes, giving weight to the idea that this may be a sustainable high. ATR has been declining since that high. New trends for this particular market do often start out a little slowly. MACD is bullish. At the daily chart level, at this high, there's a strong bullish engulfing candlestick pattern with a very long upper wick. It has really strong support from volume, supporting again the idea that a sustainable high may be in place. This upward movement is very choppy and overlapping, and it lacks support from volume. This looks like a counter-trend movement. Now another bearish candlestick reversal pattern indicates this upward little trend is over and a new downward movement may have begun, with very strong downward movement. And again now, this upward movement lacks support from ATR. ATR is declining as price is rising. Volume is declining as price is rising. These 3 daily candlesticks together complete a stalled pattern. It looks like this is another smaller counter-trend movement which may be over at Friday's high. On balance, volume remains constrained. RSI is back into neutral territory, plenty of room for price to rise or fall. ADX reached very extreme for that prior upward trend. It's now declining, indicating the previous upward trend may now be over. ATR is overall flat as price is essentially moving sideways. New trends for gold do often start out slowly because those second waves early in a trend are often deep and time consuming. Stochastics in neutral territory and MACD bearish. That's all from me this week with your gold analysis. Thank you very much for your support, and I hope everyone has an awesome weekend.